This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Don Rainey, general partner at Grotech Ventures. Grotech Ventures is a team committed to helping creative and driven entrepreneurs build technology companies that last. The strategy is simple: early investors in high potential technology companies. They initially invest from $500,000 to $5 million and look to continue investing and building value throughout the growth of their enterprise. Don, thank you for joining us.
Thank you for having me. It's great to be here.
Great. So what was your background before investing in early stage companies? What did you do before that?
I had done 5 startups of my own. A couple of them were venture backed. I came into venture capital through the back door, which is I didn't go to a great school or come from a great family. I made the venture capitalists some money, and they invited me in to join them.
Great. So what excites you right now?
A lot. I think there are a lot of opportunities, interesting opportunities. I'm doing a lot in fintech and prop tech. I'm intrigued by the blockchain possibilities in various segments, but the processing speed and some of the other operational aspects limit it. Seeing a lot of innovation enabled by 5G, the capabilities and the ubiquitous nature of smartphones means that there are a lot of knowledge workers and a lot of different types that can benefit from in the cloud systems.
Great. And so you see a lot of startups and investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Get to know the people. Make sure that they're people that are committed to the long haul and are capable of situational awareness, the ability to pivot a little bit, to experiment. I think one of the things it's part of American culture in the way we deal with failure. And for a startup to iterate, you should run a lot of experiments and have a lot of failures, and people need permission, even encouragement to fail forward, to try things and to try new things and to take the friction out of their core competencies, the things that they know they have to do well, they appreciate they have to do better, but they sometimes don't run enough tests against potential improvements. Sometimes it comes where improvements come from areas you don't expect.
And then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
Have a clear handle on what it is you know, what it is you believe, and what it is you don't know, so that someone can use that to say, okay, this is the areas you have convictions. These are the areas where you have belief but not fact. And these are the areas that you need to explore to solve for all the above.
Right. So let's talk about the state of investing. How do you see the industry evolving from here for venture capital?
Well, we're a society under pressure, and some of that pressure has resulted in people realizing that, or having the freedom, shall we say, to operate from anywhere. And I think you're really seeing that in the venture capital business. In my case, I'm based in Charlotte, North Carolina. I look for deals in the Southeast, and I find them. There are good deals in the Southeast. But what's striking is really for the first time, we're seeing bigger name California venture capital firms in market, looking around. And so that's, if you're them or you're the entrepreneurs, that's probably good. For me, it's not as good. I don't necessarily want these guys hunting the turf, but I think that's one of the big sea changes underway. The other thing I would say is that, the prevalence of larger seed rounds and people being disposed to investing in seed rounds is really a good thing. People can get a better initial 1, 2, 3 million from seed rounds. And so as an A-round investor, early investor, the companies are more mature. They may be a little higher valued as a result, and they're looking for more money. And I think that's another big trend.
Great. And over the next 5 years, what do you think is the biggest change we'll see in the VC world?
I think it'll continue to fragment, meaning there was a time when it was A investors, B investors, C investors. You now have pre-seed, seed, A. You might even get an A plus, because the amounts of pre-seed, 500K, seed, 1 million to 3 million, A round, 5 million to 10 million. The B round, as it is in the world today, is a 20 to 40 to $50 million round. Mm-hmm. I think Bs get bigger and something goes in there at A plus that's 15 to 20 for companies that are doing really well, but don't necessarily want to take on 35 million when it's 15 million they need.
Right. They're getting bigger all the time. I agree. So let's talk about your investment thesis at your firm. What is your thesis and what's your criteria for looking at deals?
Sure. So the thesis, we do, to oversimplify, we do enterprise SaaS, B2B software. Within that, we like two-sided marketplaces, logistics, fintech, proptech, cybersecurity. So there are segments within that software market that we really look at.
Great. Are there any portfolios you can talk about?
We had a couple companies, Shipmonk, notably in Florida, that really benefited from COVID, had a great year as people turned to a lot of shipping. We have the Mom Project. They're in Chicago. They enable women that are returning to the workforce, typically after having a child or two, to get back on the executive track. We really like what that company's doing. We have Pazer, which is I alluded to this type of company earlier. It's a field service management, but for HVAC companies, but particularly has a financing and payments platform, so that business in the United States is typically one where HVAC technician rolls in Monday morning, says hello, gets dispatched via smartphone app, appointment after appointment. Heretofore, they would collect payments and credit card, write down numbers and checks, and come in on Friday and dump that on the administrator's desk. Pazer enables that same tech to take a payment on phone, almost like Stripe for multi-user, enabling the HVAC company to be clearing payments overnight instead of a week later. We have a lot, there's been a very, paraphrase Dickens, or maybe to quote him, the best of times and the worst of times. We had companies that were hit very hard by COVID. Anything that had a consumer nexus or a lot of segments with consumer nexus really got hurt, but other companies got helped. I think right now we're preparing for the COVID slingshot, which is the moment when the country opens again and people can move around, and there's a lot of pent-up demand for a lot of things.
I agree. So let's talk about the challenges for the startup and the investor in today's market. What do you see as the main challenge your startups are facing, aside from the COVID situation?
Well, I think it is the transient nature of kind of the changes we have. Of the changes that we've seen in society in the last year, what will remain and what will go away? What aspects of the current marketplace will continue? One company that offered a sanitization service. They do turns for multifamily rental apartment units. So they enable, it's software to enable an apartment manager to coordinate 5 vendors in 3 days to do 5 services without having to manage and schedule, so on and so forth. But they added sanitization service in the, so does that continue? Who knows? So I think there is, the macro environment presents larger uncertainties than it typically does. On the other side of that, if you look at the 2008 and the 2000 crashes that we had, neither of the preceding ones had any kind of unlocking or end of crisis mechanism like the vaccine represents. So, this is different in the sense that at some point, when it's 50 or 70% of the population is vaccinated, the crisis is over. Our crises typically don't end with such finite, clear-cut moments. And so I think that presents an uncertainty if you know you're going to benefit, so to speak, economically from the end of this. When is the end of this? Normally you'd advise somebody don't think it's over till it's over, and you just got to wait. But because these things taper off or taper up, but this one has a different unlocking mechanism, and it's a bit of uncertainty. It's coming, and it'll be dramatic, but you don't know when it is.
Yeah, it could be big or it could take longer. We'll see. What are the challenges the investor faces in this time frame?
Well, it's hard to get to know people. I mean, obviously a lot of what we do is based on trust. And before we invest in somebody, we want to spend a lot of time in their physical presence. So affecting that relationship development over Zoom is a partial solution. But if you've been working around startups, for 10, 20, 30 years, there's nothing like walking into one to feel the vibe, so to speak, to know what's going on. Is this something with energy, and are the people really dedicated to it and believe in it? And, I've joked that you can smell success, and to some degree, I think you can. So that's harder to get over those obstacles of trust and awareness and feel of the person.
After the pandemic, you expect VCs to go back to the traditional model of face-to-face meetings with partners and portfolios, or do you think many will continue online?
It's so much. This is such a relationship business. I think there'd be a real push to get back in person.
Cool. Well, there's a lot of new sectors and applications out there on the market today. If you had to pick one or two that you think are good opportunities for investors to pursue, what do you put at the top of the list?
I think that AI is finally going to deliver value in repetitive processes and in bridges to broader sets of data. I'll give you an example. I have a company that I work with in Nashville, XOI Technologies. They use AI to do two things. So they present artificial intelligence to HVAC technicians on the commercial side. So the AI, they take a photo of the nameplate on the machine. This is a 40,000 or 20-ton air conditioner. And the AI can pull all known data, manuals, parts, and other things about that and present it to the tech. But more importantly, they can enable the tech to point the phone at the operating AC unit and listen to it and diagnose from the audible record what's wrong with it. So then it gathers, it's the third fan belt. Here's a video on how to change that fan belt. Here's the parts you need. Here's what you do. So I think AI is exciting where its scope and focus are very limited. And that's what I would look at. Things that are making life easier for people to do their jobs, making them smarter as a result.
Cool. Well, great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think there's a very interesting and broad-based movement for people to form ad hoc syndicates to support startup, seed, pre-seed, A investments. And it's presented, when you see it talked about on Twitter and other places, as a threat to venture capital. And I guess I think it's quite the opposite. I think more money, more people, more interest in the asset category of startups is only going to benefit the people in the venture capital business. So I see it as more of a assistance than a threat.
Great. You think we'll see a lot more SPVs, SPV tools, and just forming of different groups out there based on affinity or like interest in the technology or what have you?
Yeah, I mean, I think that it's part of a larger term trend. Venture capital started out as an inherently regional business, and money was there, and they invested. Silicon Valley is the best example. They had money, they had VCs, and they invested in local companies. And I think what you're seeing is this whole, and thus, with that geographic focus, which has been diminishing over time, we've now flipped it completely where these syndicates can form anywhere to support companies anywhere. The asymmetric advantage of being local is going away. I think that's good for everybody.
What do you think the role of Title III crowdfunding is? Do you think that's going to come up and grow and become an asset class, so to speak, or do you think that's simply a blip?
I do. One of the things that's kind of funny in that regard is if you're a seasoned investor in startups, you know about the Section 1202 IRS code and QSBS treatment, which simply put, for those that are not familiar with it, is if you buy a stock in a startup that's under 50 million in total assets, which all are, and you hold it for 5 years, and you sell it, you can get a special capital gains exclusion, paying no capital gains tax on that gain, up to 10 times your basis, which is fine, And in a world where the capital gains tax is maybe rising for a lot of folks, the value of QSBS, which is not well understood, it's going to become more valuable. If the capital gains rates rise by 25 or 30%, having QSBS capital gains exclusion is even more valuable. So I think people are going to look at it and say, if I'm saving for retirement, I can put a small amount in these alternative assets. I can get preferential tax treatment on them. And if I don't need that money for 5 or 10 years, that's a great outcome. It's a great part of anybody's investment strategy.
Absolutely. I think they're not very well known, the 1202 or the other two that are out there, saving you actual, taxes on your startup investments, and more people are going to recognize the value of that. We do see a lot of people invest out of their IRA anyway, because it's typically long-term money, and it's long-term startups are typically longer-term investments, and so they could be a good fit there as well. So I think people are getting smarter about that part of it. They didn't used to know much about, but we see a lot of services popping up to facilitate doing self-directed IRAs as well.
Yeah, I think that's really it's great news for those investors, and the laws are, making it easier for them to make these investments. And they need to understand that as an asset class, this is some very preferential treatment from the IRS.
Yeah, it is different, and very, very much needed for innovation as well. So, how best for listeners to get back in touch with you?
Yeah, just email me. It's drainey at Grotech, DRAINEY at Grotech. GROTECH.com.
Great. Well, we'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you so much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.